Welcome to channel Grow Wealth. In this video we will discuss about mutual funds. In the first video I have shown various ideas for grow money. They are bank fixed deposits, post office saving schemes, insurance, real estate, mutual funds, stock market, commodities, and currency trading. In this plan's first three, bank fixed deposits, post office saving schemes, insurance, are low risk and fixed income investment plans. Rest of the plans real estate, mutual funds, stock market, commodities, and currency trading are high risk and high returns investment plans. There is rule for investment. From 100 we have to subtract our age, the difference. We have to invest in high risk and high returns investment plans. And rest we have to invest low risk and fixed income investment plans. For example, suppose our age 25, then 100 minus 25 is 75, so 75% of our money has to invest in high risk and high returns investment plans, and rest of 25% of money we have to invest low risk and fixed income investment plans. Suppose our age 50, then 100 minus 50 is 50, so 50% of our money has to invest in high risk and high returns investment plans, and rest of 50% of money we have to invest low risk and fixed income investment plans. Suppose our age 70, then 100 minus 70 is 30, so 30% of our money has to invest in high risk and high returns investment plans, and rest of 70% of money we have to invest low risk and fixed income investment plans. Suppose our age 80, then 100 minus 80 is 20, so 20% of our money has to invest in high risk and high returns investment plans, and rest of 80% of money we have to invest low risk and fixed income investment plans. We will discuss this investment plans one by one in coming videos. In this video we discuss about mutual funds. Mutual fund is a financial instrument which pools the money of different people and invests them in different financial securities like stocks, bonds, etc. Why mutual funds are popular? Because first one, risk diversification. Investing in a diversified portfolio of stocks across different sectors. Hence mutual fund risk is much lower than individual stocks. Second, smaller capital. Investors can buy mutual fund with an investment as low as 5,000 only, or even lower 500. Whereas investors require a large capital to build a diversified portfolio of stocks. Third, investment expertise. Mutual funds are managed by professional fund managers who have the desired qualification, expertise and experience in picking the right stocks or other instruments to get the best risk-adjusted returns. Fourth one, variety of products. Mutual funds offer investors a variety of products to suit their risk profiles and investment objectives. Fifth, variety of modes of investments. Mutual funds offer investment modes like lump sum, systematic investment plans (SIP), systematic transfer plans (STP), and systematic withdrawal plans (SWP). Sixth, disciplined investing. Mutual funds encourage investors to invest over a long period of time in a disciplined manner to meet their various financial goals. SIP help investors to maintain a disciplined approach to investment. Hence, mutual funds are best investment plans as it provides better returns than fixed income investment plans, and it beats inflation. Different types of mutual fund are there: equity funds, debt funds, index funds, balanced funds, specialty funds and fund of funds. We discuss one by one. Equity funds. These are funds that invest in equity stocks of companies. These are considered high-risk funds but also tend to provide high returns. Various types of equity funds are there. Large cap equity funds. Invest in large capitalization companies of listed stocks, example Axis Blue Chip Fund. Market capitalization greater than 20,000 crores is considered as large cap companies. Mid-cap equity funds invest in medium capitalization companies of listed stocks, example, Dsp Mid Cap Fund. Market capitalization between 5,000 to 20,000 crores is considered as mid-cap companies. Small-cap equity funds invest in smaller companies, example, HDFC Small Cap. Market capitalization less than 5,000 crores is considered as small cap companies. Multi-cap equity funds invest in stocks selected from all the listed stocks in the Indian market, example, SBI Focused Equity. ELSS equity funds, investments made in these funds qualify for deductions under the Income Tax Act, example, Mirae Asset Tax Saver Fund. Debt funds, these funds invest in debt instruments like company debentures, government bonds and other fixed income assets. They are considered as low risk and safe investments. Various types of debt funds are there. Long duration fund, which invests in money market instruments and debt securities. Duration of the scheme is more than 7 years. Example, ICICI Prudential Long-Term Bond Fund. Medium to long duration fund, which invests in money market instruments and debt securities. Duration of the scheme is between 4 and 7 years. Example, Aditya Birla Sun Life Income Fund. Medium duration fund, which invests in money market instruments and debt securities. Duration of the scheme is between 3 and 4 years. Example, SBI Magnum Medium Duration Fund. Short duration fund, which invests in money market instruments and debt securities. Duration of the scheme is between 1 and 3 years. Example, Kotak Bond Short Term Plan. Low duration fund, which invests in money market instruments and debt securities. Duration of the scheme is between 6 and 12 months. Example, Canara Robeco Savings Fund. Ultra Short Duration Fund, which invests in money market instruments and debt securities. Duration of the scheme is between 3 and 6 months. Example, Nippon India Ultra Short Duration Fund. Overnight Fund, which invests in debt securities having a maturity of 1 day. Example, Tata Overnight Fund. Floater Fund, which invests a minimum of 65% of its investable corpus in floating rate instruments. Example, Aditya Birla Sun Life Floating Rate Fund. Credit Risk Fund, which invests a minimum of 65% of its investable corpus in corporate bonds having ratings below the highest quality corporate bonds. Example, HDFC Credit Risk Debt Fund. Gilt Fund, which invests a minimum of 80% of its investable corpus in government securities across varying maturities. Example, LIC MF Government Securities Fund. Banking and PSU Fund, which invests at least 80% of its total assets in debt securities of public sector undertakings and banks. Example, ICICI Prudential Banking and PSU Debt Fund. Corporate Bond Fund, which invests a minimum of 80% of its total assets in corporate bonds having the highest ratings. Example, GIM India Premier Bond Fund. Dynamic Bond Fund, which invests in debt instruments of varying maturities based on the interest rate regime. Example, EDF Dynamic Bond Fund. Money Market Fund, these are funds that invest in liquid instruments like T-bills, CPs, etc. Example: Nippon India Money Market. Liquid fund invests in money market instruments having a maturity of maximum 91 days. Liquid funds tend to offer better returns than savings accounts. Example: Motilal Oswal Liquid Fund. Index funds invest in instruments that represent a particular index on an exchange. So these funds are expected to give similar returns as per index. Example: HDFC Index Fund Nifty 50 Plan, SBI Nifty Index LIC MF Index Fund Nifty Plan, UTI Nifty Index Fund and ICICI Prudential Nifty Index Fund. Balanced or hybrid funds invest in a mix of asset classes. Risk and returns are balanced in these funds. Example: Franklin India Balanced. In this, equities investment 65% to 80% and debt investments 20% to 35%. Specialty funds, a mutual fund that specializes in the securities of a particular industry, sector or region, is called a specialty fund. Types of specialty funds: thematic funds, invests in specific industries like infrastructure, pharmaceuticals, technology, banking, real estate, etc. Example: SBI Infrastructure Fund. Regional funds, these funds primarily invest in a specific geographical area across the globe. Example: Latin American Energy Fund. Fund of funds invest in other mutual funds and returns depend on the performance of the target fund. These investments can be considered relatively safe. Example: Franklin India Dynamic PE Ratio Fund of Funds. Mutual fund plans. There are three types of plans. First one, growth option. In this option, gains made in portfolio are retained and reflected in NAV. Second, dividend payout option. In this option, fund declares dividend from realized profits. Third, dividend reinvestment option. In this option, dividend is reinvested in same scheme by buying additional units. Investment modes in mutual funds. There are two types of mode. First one, direct mutual fund. In this mode, investment made directly from fund house. No involvement of third-party agents, brokers and distributors. No commissions and no brokerage charges in this mode. Second, regular mutual fund. In this mode, investment made through brokers, advisors and distributors. Commissions and brokerage charges paid. Top 5 equity mutual funds. Nippon India Small Cap Fund, NAV, 88.65, assets under management, 17,554.99, 1-year returns, 75.29%, 3 years returns, 31.02%, and 5 years returns, 24.37%. Edelweiss Mid Cap Fund, NAV, 51.55, assets under management, 1,741.97, 1-year returns, 49.34%, 3 years returns, 26.89%, and 5 years returns, 20.42%. Aditya Birla Sun Life Flexi Cap Fund, NAV, 1,167.32, assets under management 15,513.84, 1-year returns, 31.36%, 3 years returns, 19.24%, and 5 years returns, 16.03%. Axis Long Term Equity Fund, NAV, 75.01, assets under management, 33,529.42, 1-year returns, 25.77%, 3 years returns, 21.02% and 5 years returns, 19.74%. Axis Blue Chip Fund, NAV 47.01, Assets Under Management 33,518.99, 1 year returns 22.36%, 3 years returns 20.62%, and 5 years returns 20.56%. Investment made in these funds through Systematic Investment Plan (SIP) mode for 5 to 10 years. There is possibility to get good returns. Thank you for watching video. If the content is useful, then share video to your friends and relatives, and subscribe the channel for upcoming videos. Thank you.